Will home prices drop in 2026?
Good question. In my professional opinion, no. There's not enough supply out there or inventory out there for home prices to really crash like the internet is telling you. Look, a crash is unlikely, right? So 2026, I believe, is going to be a flat year. Existing home sales right now are still at a 3 low territory. The national medium home price in 2025 is still up year over year, 1.7% year over year. It's slow growth. But if you look at the historic growth of home appreciation, if you look back like 65 years, homes generally appreciate around 3% on average, right? What we saw during the pandemic was a unicorn years when homes were appreciating 20+%. But nationally, where we have 1.7 on average is still appreciation and it's compounded. Everybody type in chat, compounded. That's the beautiful thing about investing, right? Everything compounds. So appreciation, whether it's slow growth, whether it's flat, whether it's skyrocketing, you still got to account for the other years prior to it, right? And the people who are in the market, meaning they own real estate, those are the ones who are going to win. And the people who are going to sit on the sidelines and try to double dutch their way into, double dutch, right? Everybody from the hood, when you kind of like, you know what I'm saying? 1 foot in, 1 foot out, you double dutching it, right? You folks are going to be the ones who are going to lose out on this appreciation and lose out on this potential to change your net worth. So I would humbly say I don't think home prices are going to drop. I don't think there's going to be a crash. I'm kind of like a broken record when it comes to the subject, and I still have been proven wrong. I've been saying this for 5 years, 6 years.
These are facts, MG. When we talk about investing, we always talk about catalyst events. There's a couple things that are coming up this year. We're getting a new Fed chair. I know you were excited about this $200 billion mortgage bonds thing that Trump is talking about. All that's going to affect interest rates. We're down here, what is it? Today's the 19th at 6%. How do you see interest rates heading into the rest of 2026?
Man, I love anytime I hear the government talking about buying bonds or buying treasuries, which not for nothing, since December of 2025, what a lot of people don't even realize is that the Feds have already started buying treasuries again. They quit quantitative tightening back in December, and they're not calling it QE anymore with the easing. It's like, I like to call it QE light, what they're doing right now. Because you remember, during pandemic, they were buying trillions of dollars, billions of dollars worth of bonds. And that's why we saw this significant drop in interest rates the way we did. But the Feds is already buying treasuries right now since December. And when Trump came out and said that he wants Fannie Mae to buy $200 billion worth of bonds, that hasn't happened yet. But if you add that on top of what the Fed is already doing, I think 2026 is going to be a great year for interest rates. Rates hit a 3.5-year low recently. They're right around 6% right now, but you can definitely get, if you're looking at a 30-year mortgage for a primary residence, you can definitely get in the high fives, mid fives, just depending on the product, the program, and your credit score. So rates are definitely lower than what they were a year ago. And if you look at refinance applications is up like 120%. December home sales, one of the best numbers of 2025 was in December for the amount of homes that sold. So with rates coming down and Trump keep talking about the housing market, man, I love it. Anytime he's talking about the housing market, man, I get a rush because I already know it's just a matter of time before the floodgates open, and there's going to be a lot of buyers that are going to hit the market once they start seeing rates in that mid-low fives on a regular basis, and that's just going to bring a lot more competition out there. So I think rates by this time next year, by 2027, we might be in the high fours, low fives.
Really?
What a beautiful thing.
Okay.
How much do you think appreciation will happen in houses? And then for anyone who's new tonight and maybe they haven't heard you speak, is now a perfect time to buy? And can you talk to them about how important it is to not miss out on this opportunity because the prices of homes have gone up so much in the last 5 or 6 years?
So that's a good question. I think there's always an opportunity cost for anything that you do, right? A good friend of ours hit me up tonight, was telling me he just got a offer on a house that he's not even trying to sell for $1 million more than what he paid for 2 years ago. Right?
That's funny. I told him to call you.
Shout out to the good friend. Right?
He called me too.
He called you too?
Yo, just tripling the opinion.
A good friend is making his rounds and calling the experts. You know what I'm saying? But and guys, I'm glad. And I didn't know he called y'all, right? But that's just what's happening. He has time in the market, and people are out there wanting to buy. And we're not talking about a small house. We're talking about a multi-million-dollar home. So if folks are new to me, please understand, there's no better time to buy real estate than when you can afford to buy it. Right. I don't care what the market is doing. You got to look at your individual goals, right? Look at your credit, look at your assets, look at your income, your job security. If you're self-employed, look at your business, look at your net. If you're self-employed, to see if you can really afford it, because homes are not just your mortgage payment. You have expenses that come with maintaining that house. And especially the way taxes and insurance are increasing rapidly across America. It's not about what that payment is for your first year. You got to be looking at 5 years down the road. So if you can afford real estate, then I believe absolutely you should go ahead and buy, but buy smart, right? Stop buying at market prices. Stop buying at these retail prices. You can look on Zillow and MLS and work with realtors, but you got to learn the art of negotiation. Right now, the ball is in your court as a buyer. But that is going to be short-lived if these rates go down, because as these rates go down, it's going to bring more buyers into the market, which is going to create bidding wars. And I don't want to hear nobody in the comments talking about, oh, he's crazy, there ain't going to be no bidding wars. You ask some realtors in some of these markets today, they still have bidding wars happening, and they haven't dropped down over the past couple years. Now, every market is different. Every market is local. But, I definitely think people should definitely buy if you can afford to buy.
Real estate is fastly becoming a luxury item. The average first-time home buyer is in their 40s for the first time ever. Less and less people are buying home, can afford to buy a home. So, okay, for the people that saying, okay, I understand real estate's an investment, but how can you buy a home? How can the average person buy a home in today's economy? Like, what are some programs? What are some tips? What are some hacks? What is some advice that you would give somebody that just feels defeated in the marketplace?
Good question. If you feel defeated and you don't know if you can afford to buy the home, because let's face it, affordability is definitely an issue in most cases. But I'm going to be real with you guys. I've been doing this for 23 years. 2026 makes 23 years I've been in the mortgage business. I'm not just a content creator. I'm a licensed professional. Allow me to reintroduce myself, Matt Garland, NMLS number 58700, better known as MG the Mortgage Guy. I've been doing this for a long time. This is my Jordan year. And since I've been in this game, people couldn't afford a house. There's always been an affordability issue, just depending on where you live and where your income is. I think where people got to focus, if you can't afford to buy a house right now, that's okay. Learn how to trade and watch Market Mondays.
Big facts.
And learn how to create another source of income. Folks who don't have the money, who may have limited savings, you have to learn how to invest and pick up this skill set, because even for myself, y'all, and I'm being very transparent with y'all, when I saw that, I said, you know what, Troy, this is my year when I'm going to learn this game like I know real estate. And by this time next year, I'm going to beat the S&P by a landslide. I even told y'all when I came on this backstage, like, this is my year to beat the S&P by a landslide, because I am a believer in this, and I'm a believer in y'all teaching, right? So that's number one, Rashad. Learn a skill set to make more money. Now, if you are someone who can buy a house, but you feel like it's still not affordable, and you might not want to be the person who wants to house hack your way to wealth and do the 4-3-2-1 strategy or buy multifamilies and things like that. Well, the zoning laws are changing nationwide, where many cities and states are now allowing not just for one ADU. A ADU, for those who don't know, is an accessory dwelling unit. Is basically like a tiny home in your house, on your property, right?
Mm.
So many of us live in these states where even New York just approved where you can have an ADU in your backyard or convert your basement into an ADU, right? Because they understand affordability is an issue. These states have these options to where you can have ADUs, but Fannie Mae just came out a couple weeks ago, and now they have expanded their ADU rules, which allows you now, and they will give you the money for rehab as well, where you can now have a single family unit and put up to 2 ADUs on that property, right? And Fannie Mae will allow you to use one of the ADU's rent, at least 30% of that rent, to allow you to qualify for the mortgage as well. So if you're buying a primary residence and you have the capability, and the town allows you to have an ADU, whether it's attached garage, a basement, you can build it on your property. This is a great way for someone who probably can't afford to live on their own or afford that mortgage 100% to now supplement their income on a single family. And if you are someone who lives in an area where there's a lot of duplexes, Fannie Mae allows you to now put up to 2 ADUs on that duplex as well, as long as you don't exceed 4 total units on the property. So what we're starting to see on the mortgage side, mortgage guidelines are now starting to catch up with the times, because they realize, Fannie Mae, Freddie Mac, FHFA, they realize that the times are changing and we have to make things happen for the consumer in today's 2026 market. So to me, I think this is a home run, and you can get 100% of your rehab costs. This is a game changer right here.
So here's how it works. If there's more demand for mortgage bonds, then the price of that mortgage bond is going to go up and the interest rate's going to go down, resulting in lower mortgage interest rates. And President Trump has ordered Fannie Mae and Freddie Mac to buy $200 billion worth of mortgage bonds, which will increase demand. So the average interest rate on the 30-year fixed mortgage right now has fallen to 6%. And I want to show you the average interest rate on a 30-year fixed mortgage over the past 5 years. After hitting this peak near 8% about 2 years ago, it's been drifting down. However, we've been stuck in this 6% to 7% range for the past 2 years. So perhaps this order by President Trump will finally take the rate down meaningfully below 6%. Okay, so you may have seen the headlines like this, how Fannie Mae and Freddie Mac could push mortgage rates lower. Now, I just want to explain the situation in more detail. Here's what President Trump wrote on January 8th. I chose not to sell Fannie Mae and Freddie Mac in my first term, a truly great decision, and against the advice of the experts. It is now worth many times that amount, an absolute fortune, and has $200 billion in cash. Because of this, I am instructing my representatives to buy $200 billion in mortgage bonds. This will drive mortgage rates down, monthly payments down, and make the cost of owning a home more affordable. In September of 2008, the US government stepped in and they were bailed out. Both companies were placed into federal conservatorship overseen by the Federal Housing Finance Agency. And this is where things get very important. So since 2008, the government controls their balance sheets. The government controls their capital. The government controls their strategic decisions as well. So they are still legally companies, and they still technically have shareholders, but they are under the control of the government. That's what it boils down to. Now, a very good question is, are Fannie Mae and Freddie Mac publicly traded? And this is where a lot of people get confused, because the answer is yes, but not in the way that you think. Fannie Mae and Freddie Mac, they do have publicly traded shares, but they're driven almost entirely by politics and court rulings. Okay, why? It's because the common shareholders, they have no control. They sit behind the US Treasury in the capital structure as well. And in fact, the US Treasury holds warrants that allow it to acquire nearly 80% of the common stock of each company if exercised. So that's why it's basically under the government's control. So when people are trading these stocks or investing in these stocks, they're not investing in like earnings growth. They're really betting on conservatorship reform or legal outcomes or future recapitalization. So this is why these stocks behave more like political options than traditional equities. Now, let's talk about the headlines that triggered this entire conversation. Okay, so President Trump has ordered Fannie Mae and Freddie Mac to purchase approximately $200 billion in mortgage-backed securities, and that is a massive number. And it's important to understand what's happening. The government is using Fannie and Freddie to influence mortgage markets. So in plain English, Fannie and Freddie are being told to step in as large buyers of mortgage bonds, increasing demand for mortgage-backed securities, MBS. And when demand for bonds go up, the price is going to rise and interest rates are going to fall. And mortgage rates tend to come down. So that's the goal. Now, I just want to address this. So why is this unusual? Like, why is this such a big deal? It's because historically, when policymakers wanted to push down mortgage interest rates, they relied on the Federal Reserve. So you can think about 2008 during the Great Financial Crisis or 2020, the pandemic stimulus. So during those times, the Federal Reserve bought trillions of dollars of treasuries and MBS. But this time, it's different. The reason is because this time the Federal Reserve doesn't want to help. They don't want to buy MBS. So instead of the Federal Reserve doing this, policymakers are leaning on Fannie Mae and Freddie Mac, and by extension, taxpayers. So this blurs the line between housing policy, fiscal policy, and monetary policy. And this is why this move has raised eyebrows across Wall Street. Now, let's answer this question. Has the buying started yet? And the answer is yes, but slowly. Initial reports indicate that early purchases have already begun, though the full $200 billion is expected to roll out over time rather than all at once. And this matters because, well, if you're going to go after $200 billion of MBS just, overnight, then that's going to cause major distortions. So instead, they want to roll it out gradually. But even though that's the case, the markets are already reacting to this. Now, moving on to this question, who's going to bear the risk of all of this? And here's the uncomfortable truth. If these purchases of mortgage-backed securities, MBS, go poorly, then taxpayers ultimately absorb the downside. Okay, why? It's because Fannie Mae and Freddie Mac, they're still under government control, and they still rely on Treasury support, and they still lack full private capital buffers. So this means that losses are going to be, they love to use the word socialized. So losses are going to be socialized, which just means that taxpayers are going to bear the burden. And I just want you to know that, of course, there's going to be critics. There's going to be people supporting this. There's going to be people against this. And some people are arguing not to do this because they're saying that this type of policy is going to distort markets, it's going to delay reform, and it's going to entrench government involvement. But then you have the supporters, they're saying the opposite. They're saying that housing is too important to fail, that mortgage stability is a public good, and that intervention is justified. Now, I just want to zoom out and take a look at the bigger picture because this move tells us something important. It tells us that policymakers are uncomfortable with high mortgage interest rates and that the Federal Reserve, they're not going to budge on purchasing MBS. And they are increasingly willing to use hybrid institutions to manage outcomes. Okay, with that being said, I want you to realize that this is not a free market solution. It's a managed market solution. And whether you agree with it or not, it reflects a broader trend. When markets become politically sensitive, governments step in. But the reality of the situation is that housing still remains very unaffordable, especially for first-time homebuyers that have not been able to build up home equity. And one way to tackle this is to lower mortgage interest rates. But the Federal Reserve, again, they're not going to buy MBS and help lower interest rates for mortgages. And Congress, they're not going to provide additional help. So Trump's doing this through Fannie Mae and Freddie Mac. And if you ask the question whether this is going to work or not, I mean, nobody knows. We'll see, but that's the plan. And now you know it. However, I just want to say that this $200 billion initiative, it may help mortgage interest rates in the short term, but it raises serious long-term questions about risk, incentives, and of course, government involvement.